Welcome back to AM Northwest. Trade wars with China have been big news lately. So what does that mean for our retirement plans? Here with important information, we welcome back financial planning and consulting specialist David Swanson. Good to see you, David.
Hi, Helen.
What is going on right now?
We are in a struggle, in a war, in a battle between what we think we want to have and what we've had in the past. And tariffs, penalty for providing subpar service to a particular country, and these tariffs are supposed to balance this out, have been used in the past unsuccessfully in great degree, but we're doing it again. And we started out with a $50 billion tariff on China, and today we implemented the second phase of this, which is $200 billion of tariffs on goods and services, which is an increase in cost of them to do business with us. That's about half of the trade that we have with China right now.
So what does that mean then for us? I mean, does that mean higher consumer prices?
It has to, because if their cost of production is increased, one of two things will happen. Either we'll stop buying that product because the price is uncompetitive, or we will switch then to the United States goods and services, which is kind of what's happening.
Yeah.
So, but in this world environment, what companies don't have some type of factories and facilities overseas? Almost every company, major companies do.
So what does that mean when we talk about retirement? Because one of the questions you say is, the questions here, are you prepared for what is to come?
So if you haven't thought about this event is happening. And if you're not having your eyes wide open moving forward to this, and your retirement account is in a protection mode for this, you could be blindsided by it. And this is very, very bad. So in the last dozen years, we really didn't have to do much. Interest rates went down, stock markets went up, we did pretty good. But this is the time you need to really take a look at what you have, because we've never seen any kind of economic moves like this before. And frankly, nobody really knows what's going to happen.
So then you say we need to look at if we're too heavily invested in the stock market.
That's another big thing. So if you're not prepared, if you're overly invested in equities, that's another reason that you really need to have your accounts reviewed to be prepared for this. The main problem is that as people are at and near retirement, you don't have the time to earn that money back. When you're younger, this is not such a big issue. So for millenniums, they're not, my son is not such a big problem for his friends in their 20s and 30s. But when you're in your 50s and 60s and you're getting ready to retire, you simply don't have the time to earn this back. You need to pay attention right now.
And another question you bring up is to ask if your advisor is shifting your life savings into bonds.
So this is what happens is that, and I've been doing this business for quite some time, when interest rates cycle, interest rates move down, bond prices appreciate. That's why we've enjoyed this great benefit that we've had over the last dozen years. But if you think that interest rates are going to rise in the future and you're buying bonds, those bonds will decline in value. There's an inverse relationship between rising interest rates and bond prices. So if your money is being shifted into bonds, you may actually find yourself losing even more money. So you have to have the proper type of plan in place.
Right.
And this plan, of course, as we've talked about this many times, needs to be in writing.
It has to be a written plan.
Draft it out, think about it, look at it all, enjoy it, review it all, and then you can move forward. But if you are having these concerns with your accounts and you're getting ready to retire, you really need to give us a call or come to one of our free workshops. But at the end of all of this, find a fiduciary advisor. Find somebody who has your best interest in mind. And if your advisor is not giving you that, seek out the help from somebody else.
Now, we have a number of questions from our viewers.
Yes.
So we're going to take a break and we'll answer those questions when we return. Don't go away. Thank you for watching AM Northwest. David Swanson from Swanson Financial is back to answer your retirement planning question. Now today we're talking about trade wars and our retirement plans. So question number one, my husband is 63 and wants to stop working, but he's worried we won't have enough money for him to retire. We have an advisor. He is not a fiduciary and does not hardly ever call us. Can you help?
We certainly can. And you need to have your plan in place. It needs to be organized. It needs to be in writing. And if you don't have that, you could be in real trouble.
And a fiduciary guarantees that you're looking out for the client's interest,
We're
not
by
your
law
interest, by law.
required to have a higher standard of care than the average advisor.
I am 65 and invested mostly in stocks. I just retired after 30 years with the electric company. My advisor wants me to shift to more international stocks. I'm not sure I should be in any stocks. Can you review my accounts and how much will this appointment cost me?
First part of the question is, my opinion is that international stocks have always been very risky. And yes, China is down more than 20% right now. It's down to levels of 2014 in some of their major indexes, which presents to me a very, very large risk situation. Now, if these tariffs that we're doing, our markets are going up and overseas markets are declining, there's a lot of uncertainty there, and try to figuring out if this is the absolute bottom in a foreign market. Again, I say, if you're close to retirement, it's too risky to be taking those chances.
Right.
You should be in a much more modest type of an investment plan. We don't charge any fees for initial consultation. If we can do something for you, we'll set up a fee plan. We're fiduciaries. It's all in writing before you pay any money. It's all in writing. You know exactly what you're going to pay before it happens.
I just received an inheritance from my mother's trust. The advisor lives in a Midwest state, and I've not spoken to him very much over the last 5 years. I would like the account here locally. Do you handle trusts, and can I meet with you?
We absolutely do, and we get many phone calls from this show of this exact situation. And it's your family lived in another area, you have another advisor, you want something closer at home, you want someone you feel that's more trusted and you feel comfortable with, that you can go see them on a regular basis. We'd be happy to help this individual.
We are both close to retirement. I never really spent much time looking at our brokerage statements as they are so complicated. It looks like we have many mutual bond funds. Are they safe? And if interest rates rise quickly, are we going to see losses in our accounts?
You got it right on, and that's exactly what happens. And when we see these big spikes in interest rates, that is tremendously risky environment, especially if you're looking to be spending that money right away. And most retirees, if you have losses in your first or second year, significant losses, 20, 30%, you could shorten your income by 10 or 12 years. So it's really, really important to not make so much, but just to protect the principal that you have, slow and steady to the end of the race.
Okay. We have been heavily invested in the stock market for the past 2 years, but our values are nearly unchanged. Why is this? And can you please review our accounts and give us your opinion?
There was an article in Wall Street Journal this morning talking about how the bear market inside the S&P 500, there's a handful of really large stocks, Stanley Works, Harley Davidson, some other international conglomerate stocks that have been marred in all of this overseas decline, and their values have not done well. So if you would have bought basic, hardline, regular old stocks that your parents may have owned, those stocks may have actually gone down in value, while the rest of the stocks, Amazon, Facebook, those types of companies, have driven up indexes much higher. So it's where you are in the market. The question is, what happens when Apple and Facebook start going down and Amazon goes down in value?
Yeah, absolutely. Well, tell folks if they'd like to find out more, you can contact Swanson Financial, 503-603-9900. We'll put the information for you on our website at katu.com. David, thank you very much.
You're welcome.